I think a good place to start this podcast too is kind of segueing from that topic, but for the general market. Like, at what point do interest rates start becoming a problem? Like, we're back up to where the 30 years back up to where it was when the stock market was panicking, but that happened very quickly during that liquidity cascade. Now we're at the same levels, pretty much at the same levels, and stocks are ripping. So at what point does this become an issue for stocks?
Well, I think that obviously the rise in yields comes down to number one, is it term premium related? And number two, is it inflation related, right? Like if inflation expectations are anchored in higher and yields therefore are higher, then and growth is stable, at least somewhat stable, right? Then it's not necessarily a bad thing. So I don't know if you can just correlate that one to one and basically say like, oh, just because yields are going to go up, they're going to break equities. I do think that the higher yields go, the more they can drag on equities, but it's not necessarily going to be a yields go up and equities just snap type of situation.
Yeah. Well, so in this week's been pretty intense. Nasdaq's just been ripping, the S&P's just been ripping, and nothing has really changed. Like we have the China negotiations going on. The Chinese tariffs were put on hold for a bit and pushed back, and stocks are just ripping off of that. And I I don't know if this is really going to continue for much longer. Like today, we just saw there's the momentum kind of died off. Nasdaq did close bullish trend, so that is a good sign for the recovery. But it does seem like it's getting exhausted here, and I could see a possible pullback to Momo before continuation forward.
Yeah, so you make a good point there. Like I think that there is some momentum exhaustion that at least has to be considered here. And I don't know if it's necessarily yield related because, as we were just saying, 30 years clapping on 5% here and market's still up and to the right type of style here off the lows, which doesn't necessarily mean that, I wouldn't try and put so much of a correlation between rates and stocks at the moment. I would just look at stocks and say the amount that you've moved in the last couple of weeks has been pretty aggressive. Now, some would say, "Oh, you're just making up for lost time, right, for the drawdown." But to think that the market's going to just linearly rise up and to the right, it's probably a bit foolish, right? I do think that there's some corrective steps that'll happen along the ways, and positioning for those when they present themselves with the proper regime is probably going to be the next step of the tour here in the macro regime, right?
Yeah, I think this is like a combination of stocks playing catch up. Like the S&P hasn't really gone anywhere since December last year. And so there's that catch up factor plus a mix of some FOMO coming in, coming off of the lows there. People that missed out on buying the dip, they're seeing, okay, the trade deals are starting to come in. There are negotiations happening. It's not going to be as bad as everyone thought. And so we have that FOMO buying also coming in and pushing stocks up. And I do think that we are getting to the point where it's starting to get a little bit exhausted now that we're up to the December 2024 levels where we kind of stayed a little bit as growth started deteriorating initially when we had our first sell signal to sell at the NASDAQ end of December. So now that we're up there and growth isn't better than it was back then, maybe it does get better. We'll see. We'll have to see where the growth index goes from here. But currently, it's not better than it was back then.
Yeah, that's a good point. So growth essentially in terms of impulses has done a lot of repair, right, over the last couple of weeks, month or so, given the market has also repaired itself, right? But the impulses themselves haven't drastically shifted to where they were prior to us going into this whole debacle in the beginning of March. So we've kind of just gone back to where we started. It's not bad sign, but it's also not like a we're so back bull market on ripper sign, right? I think some people are also a bit hesitant with the whole situation here with tariffs, right? Because you have this dilemma, right? Where there's pauses on pauses, right? We have the original 90-day pause, and then we have a pause within a pause with China, and everyone's just trying to understand like where do we actually continue from here? Is the worst actually behind us, or is there more volatility on the horizon? And I think that we can't really make that determination just yet. But ultimately, I do think that there are some things that the administration tried to do, but the markets kind of called their bluff, and without them ultimately capitulating, they did softly in a lot of smaller ways, which in the end is a capitulation, right? The way that they back down off of certain tariff pass, and the way that they kind of walk themselves back along the way. And I think the market is picking. That's what the market's really picking up on, is a lot of these tariff induced shocks in the market were necessarily being repriced out and up, as the market's like, okay, it's a lot of it's a lot of barking, but the biting is not as bad as we initially thought. And
Yeah.
I think that as long as those bites aren't hard or not or don't come quick, I don't know. I think the odds become lower and lower and lower that we need to see the April lows, and more so maybe those lows are in, but until we're in a risk on regime, there is high risk of chop, right? That's just part of the cycle. If you're and anything but risk on, the chop risk is pretty high, especially on risk on assets like the Nasdaq.
Yeah. And possibly Bitcoin as well. Like Bitcoin's kind of lost some steam too. It's not really continuing forward, which it does this though. It kind of does this step ladder, spike up, consolidate for a little bit, and then spike up. But we'll have to see how growth goes from here. Like I think Bitcoin saw this growth rebound before stocks even saw it. It's pretty crazy.
Yeah, I kind of have to agree with you there. I mean, at the end of the day, I know that there's this famous chart going around. I think it's by is it by I think it's Real Vision that has it with money supply overlaid with Bitcoin price, right? And lagged by like I don't know 18 months or something ridiculous, right? Something super long. And in reality, the market it's working right now, but in reality, the market is efficient enough to not be late by 6 or 18 months or whatever, right? The market is efficient enough to see information real time. So I think that ultimately a lot of people are going to probably attribute this to some money supply increase or whatever, but I think that like really what happened, just as equities are showing you, you didn't actually hit a recession. And I think equities really were like or like you're on the borderline now of actually leaving slowdown, right? Like you went from risk on. So let's go over the cycle here. Last year, we go from risk on to slowdown into Q1, and then we basically go from slowdown to essentially recession pricing, and then we leave recession pricing and go back to slowdown, right? But we haven't really gone back to risk on. So I think that what happened with Bitcoin is the same thing that what happened with Nasdaq. Is just that look, the initial shock here was this idea that we could be seeing a deeper slowdown, maybe even a recession. And once that kind of came off the table, it was back up and to the right. And I'm not too sure it has anything to do with M2. I think that might be just a misplaced correlation. But ultimately, everyone who's long Bitcoin, including us right now, are happy either way. And we hope it continues.
Yeah, we pretty much just got to see what the next regime is. Are we going to stay in slowdown and possibly head back down towards recessionary pricing again, or are we going to go into expansion? That would be the next logical step, would be expansion. And really, who fucking knows? I really don't know
Well,
what's going to happen.
I spent a lot of time thinking about this the last couple of years, and like I know it always comes up in conversation, but like with the current position of fiscal and where the Fed is, right? Like some would argue that it's very hard to actually materialize a recession in this environment. Not saying you can't have a slowdown, right? I think that's a bit different, but in the sense where like labor completely falls off a cliff and inflation completely falls like a rock, when you have inflation at 2%, roughly 2%, and the fiscal's at 6, the Fed's at 4, right? And these obviously are like uncorrelated. You can't just overlay all these into one chart, but these are just data points, right? And you look at what's happening with like future spending, like 3 months ago, it was all about balancing the budget. Now, I almost feel like they've kind of thrown that down the drain. Unfortunately, I don't think at the end of the day, balancing the budget was extremely aggressive to begin with. But this idea that we're going to even cut the deficit in half seems like something that like it's like a good analogy is like something floating away in space. Like you can see it, it's slow, but you can't grab it, and it's just drifting away. Like that's what this feels like right now.
Yeah, and what even happens if they just don't tackle the deficit? Is like what if they just kick the can down the road? What even happens then? Does it even matter?
It's a good point because, like, at the end of the day, like running a 6% deficit right now in this specific situation, inflation is at 2, right? And down the given the reason that I believe that. So look, you're at a 6% deficit, but you're at a positive output gap. So basically, the economy is running hotter than its potential. Therefore, the risks for inflation are high if the central bank starts lowering policy quickly, which is why the Fed is very adamant about remaining tight and they're well positioned because they see, look, Jerome can't get up there, Powell can't get up there at FOMC and be like, yeah, like we want to cut rates, but fiscal is just we can't. Fiscal is preventing us from doing our job. And they don't want to come off as giving fiscal advice, as Powell clearly said in other words in the last FOMC that fiscal doesn't need help with fiscal, and monetary doesn't need help with monetary, right? Like the government doesn't need the Fed's help, and the Fed doesn't need the government's help. They want to be independent, so they really can't come out and start giving advice as to what the government should do in their FOMC statements as to why their policy is where it is. But under the table, behind all the curtains, away from the spotlight, the Fed is having to stay restrictive because of the deficit because the deficit is at a level that would typically happen in a recession, right? In a recession, when the economy is running under potential, you use a deficit to stimulate the economy and bring it back up to trend and potential. When you're above potential and you have this deficit, and we'll drop a chart in here so this makes more sense. But if you're running above potential and you have this high deficit, what's going to happen is you're just overheating the economy, and this will bleed into inflation at some point. So the Fed is being much more restrictive than they would normally have to be in an environment, right? Because they have to compensate for the excess deficit that's pushing the economy into overheating stage, and therefore they have to remain tighter, higher, and longer than a lot of people expect. Now, I think that as of right now, your question, what if the Fed doesn't do anything? Nothing happens. If the deficit, excuse me, nothing happens to the deficit, nothing happens, then the Fed would in turn do nothing, nothing happens. Literally, the Fed is giving you projections of the deficit not changing. Therefore, like the Fed's path is essentially dependent on the deficit and in turn a recession. But the interesting thing about the situation is when you're running a positive output gap like this, recessions don't just come overnight unless they're COVID. Like they take time to progress or they're a crisis. So without COVID or a crisis, it's going to be very hard to chew away the economy with so much excess output in the economy. Therefore, it's almost like a catch-22 because unless they adjust the deficit, there likely isn't going to be a severe recession. But the Fed is also going to have to remain high, which is going to put continued pressure on the economy and in turn can slowly deteriorate that positive output gap over time, give it years into turning into a recession. So it's like a push and pull here. The government can decide to do nothing, walk away from the fiscal problem, lay down their swords, and say, look, there's no recession. I mean, there's no reason for us to cut spending. We'll just grow out of it. No biggie, no problem. And it won't be an issue right now. It's not like the government's going to default on its debt. Yeah, there's a refinancing wall, but term premium's already up 50 to 60 basis points. So the market's already kind of front running that a bit, if you ask me. And they have to refinance all this debt. Obviously, that's the refinance wall. And then they also have to navigate this whole tax cut thing, which they're trying to do. And how that affects the deficit, we'll find out given what concessions they're willing to make to get that tax cut bill passed. Ultimately, they can do all this, kick the can down the road for a year or two. I don't think anything happens. The government's not going to default at the end of the day, right? U.S. is not going to default. Inflation is not going to go from 2 to 10%. Like you're not going to get that inflationary push as long as at the end of the day the Fed remains resilient in the fight here. They don't just fold like a cheap beach chair and they just stay steady. That you're not going to get that excessive bleed of inflation. The consequence of this is going to be higher for longer interest rates, meaning like let's look at the 30-year, right? The 3.5 to 5% range becomes the norm type of thing, right? Because you have to have higher baseline rates if you have an excessive deficit in an overheating economy. Now, as the economy cools, because if rates were not restrictive at all, inflation would be rising. Inflation wouldn't be under control. So think of it like the Fed is actually doing something here. They're holding down the economy, but it's enough to bring inflation down slowly, not enough to really make inflation drop like a rock, and not enough to crush labor overnight. So they're just like a light paperweight on the desk type of thing. Their paper's still flapping, but it's not really moving. That's what's going on here, right?
Yeah.
Everything's just falling slowly. So if the Fed holds course, I think that over time, there is an opportunity here where the government can outgrow this deficit issue by basically capping spending and running GDP with lower inflation and therefore essentially outgrowing the deficit. But it's a hard task. It's a hard task. And the market right now is, again, back to your point earlier, the market right now is not a make or break it point for the deficit. I think bonds originally off the lows here, when rates went haywire, were under the fact like you actually had at that point a US dollar issue. You literally had a rapid move in dollars where people were saying, oh my God, it's over for the dollar, right? And that fear kind of manifested itself. People started dumping duration. There was a bit of a global shock there, but it wasn't necessarily, remember, zoom out on the dollar. We're not even at 2021 lows. So that kind of reversed itself a bit. And I think TLT was able to catch its footing. Volatility in TLT has dropped a bit and things have kind of settled down. Nonetheless, I don't think that without the government doing so, it's not an imminent problem. It's not like the debt ceiling, right? If they don't raise the debt ceiling, then they're going to default. That's not what's going on here with the deficit. The deficit could run 6% for the next 3 years, 4 years. And it's essentially not cooked for America if they do that.
Yeah. But during that whole process, bonds are going to be pretty much untradeable.
They may be. See, the thing is that it depends. Like we're always in a situation where we have to look at, just because the output gap is positive, right? What would make bonds untradeable in the situation is you have a 6% deficit in a positive output gap economy with the Fed at 4%. So think of it like this: unless the deficit gets cut, or unless spending gets cut, or tax revenues go up, or we just grow out of this, right? The Fed is going to have to remain more restrictive than they normally would in an environment if say there was a 3% deficit and low output gap, right? They could be a lot lower. So in turn, bonds will start looking at the directionality of that. So let's just say that output gap is 1.5 or plus 1%, right? But it falls to like plus 25 basis points, right? And it starts falling, it starts falling, it starts falling. Well, what's going to happen there is the bond market's going to start picking up on the ability of or the inability for the market to absorb that fiscal deficit stimulus. Therefore, the Fed is likely too tight, right? The Fed will in turn reduce rates to calm that scenario there, right? To prevent the economy from breaking into negative output or into a recession, or aka too high unemployment, right? They'll come in and backstop that a bit. But in turn, you're not necessarily getting that full cutting cycle until either you grow out of the deficit, they cut spending, or they raise taxes. And right now, the admin is really betting on the first one, being to outgrow the deficit. They're betting that they can outgrow and basically wrangle in the deficit over time just through economic growth, deregulation, and whatnot. And it's possible, but They
That's
only have 3 years.
yeah, and that seems like a recent plan. Like it was all about the deficit initially. Like we got to save
I know.
money, we got the Doge cuts, like we got to be more conscious about America's spending. And now it's all about okay, fuck it, that didn't work. Let's let's try to outgrow it now.
That seems like to be the case, honestly. Like I said earlier, it seems like that the original plan of look, we're gonna Doge is gonna do wonders has been drifting away, and
Yeah, Doge
I
was
don't want.
supposed to
I'm
cut
not.
like 2 trillion. They ended up cutting 150 billion.
Yeah, I know. And look, I think that the intentions are good, but to some degree, I think that there's also a wide variety of political issues on the table. That's what each side is fighting each other, and like in reality, see, this is where the tax cuts are very, very interesting, let's say the least. You can argue that the tax cuts are going to cut revenue by $4 trillion over 10 years or whatnot, right? It'll cost $4 trillion over 10 years. Now, the counter to that argument is what will it do to growth? Will the tax cuts substantially grow growth enough to offset the loss in perceived revenue? Therefore, if you can grow GDP enough, right, you essentially can cut the deficit down. You see? But it's as long as the spending portion doesn't balloon on its own within the deficit. So it's such a like a catch 22 here where you have multiple people trying multiple different angles, and ultimately it comes down to the end of the day, this all comes back to just spending control. We spend way too much money on things that we probably shouldn't. And the argument to that is either spend less or hike taxes and let growth do its thing. I think that's what the more mature approach to the whole thing would be, either one or two, and the other one is like, the cowboy approach is let's see if we can outrun this bad boy.
Yeah, which seems like that's the game plan at the
Uh,
moment.
it seems like that is the game plan. I mean, look, bonds are going to trade up and with the premium unless you get that recession. And again, with the output gap where it is, unless that really deteriorates, you're not going to get a recession for the most part without a crisis. So unless you think that the Fed is going to cause a crisis, which, in my opinion, that boat has came and passed. Right, that was SVB. That was the crisis, and they backstopped that within literally like a week. So I had to sit here and say the Fed's going to create a crisis. I don't think that's the case. I think that if anything, the tariff shocks had the ability to create a crisis, but once the admin realized like it was no bueno, they walked that back so quick. They folded again like cheap beach chairs on some of these policies, and they did it in a manner that was like incremental. So they didn't just like if they would have just came out on day one and said, "Look, this is the deal." I think that we would be here a lot quicker. But the way it was done was yes, no, yes, no, yes, no, and it was like it's been like an upwards battle, but it's nonetheless we're going up. So this is a good sign. We want equities higher at the end of the day. I mean, I think you would agree, right? Look, the best and easiest regime is a risk on regime where you're long like TQQQ and chilling. That's literally the best
Yeah,
regime. And
just
Bitcoin.
low volatility, low VIX, and just riding the waves, going out touching grass, not worrying about your portfolio.
Yeah, dude.
That's the
That's
ideal.
like the best. That's the best. Yeah, it's been a rough couple of months, rough quarter and a half, obviously. Not just for us, but for pretty much anyone with any market exposure. First we went from selling risk assets. The market went from selling risk assets. Then it went from risk assets to outright just selling US dollar denominated assets. And then it went to selling bonds, right? With the US dollar denominated assets. The only thing that really functioned well in this time period was gold and some foreign equities. And I think we'll see that come back. I think you'll see some reversion here in the EZU SPY um, ratio, where like long Europe to short SPY. I think this will trend lower over time. I think a lot of the shocks that came with this dollar dump will even if the dollar doesn't necessarily reverse all the way, will get unwind as like hysteria comes back in line and people start realizing again that the United States is not going to die. If you guys have any questions, feel free to reach out to us on our website at market-radar.com or go to Twitter at the market radar.